Hi everyone, welcome to Whiteboard Finance, where we break down complex financial topics into simple explanations so that you can make smarter financial decisions. In this video, we're going to talk about the 5 investing mistakes beginners make. Let's get started. Mistake number 1 is trying to time the market. Many investors are guilty of trying to predict when the market will go up or down in order to maximize their returns or minimize their losses. But here's the thing. No one knows what the market will do next.
Trying to time the market is like trying to catch a wave. Sure, if you manage to get in right at the peak, you might be able to ride it all the way down and make some good profits. But if you miss the peak and end up getting in too early or too late, well, then you're going to be left behind. The same goes for selling. Trying to sell at just the right moment to avoid a crash can be equally tricky. And many investors have been known to panic sell. At the bottom of the market, this only makes things worse because you're selling your investments for less than what you paid for them. If you want to avoid these common pitfalls, it's important to resist the urge to try to time the market. Instead, focus on building a diversified portfolio of index funds and ETFs that track the market. This way, you won't have to worry about when to buy or sell because you'll be buying and selling the entire market in one fell swoop. Plus, by diversifying, you'll be able to reduce your risk and increase your chances of making money over the long term. So don't bother with trying to time the market. Just buy and hold and let compound interest work its magic. Mistake number 2 is not having a plan. When it comes to investing, it's important to have a plan before you start. Without a plan, you're more likely to make impulsive decisions that could cost you a lot of money. That's why it's important to take the time to figure out what your goals are and how investing can help you achieve them. For example, are you saving up for retirement? Maybe you want to buy a house or fund your child's education. Once you know what you're investing for, you can start to develop a strategy. How much risk are you comfortable taking? What kind of return do you need to meet your goals? How long can you invest your money? By taking the time to answer these questions, you'll be able to create an investment plan that works for you. And remember, your plan should evolve as your circumstances change. For example, if you're nearing retirement, you may want to shift your portfolio to be more conservative. By having a plan in place, you'll be better equipped to handle whatever the market throws your way. So don't make the mistake of jumping into investing without one. Take the time to develop a sound strategy that meets your needs and helps you reach your goals. Moving on to mistake number 3, which is not diversifying. Not diversifying your portfolio is like putting all your eggs in one basket. And we all know what happens when you drop a basket. All the eggs break. That's why it's important to diversify your investments so that you're not relying on just one stock, bond, or other asset to make you money. Diversification helps you reduce your risk and increase your chances of making money over the long term. There are many ways to diversify your portfolio. You can invest in a variety of asset classes such as stocks, bonds, and real estate. You can also diversify within each asset class. For example, if you invest in stocks, make sure to invest in a variety of industries and sectors. This way, if one stock does poorly, it won't have a major impact on your overall portfolio. It's also important to remember that diversification doesn't mean holding on to everything. If you own a stock in a company that isn't performing well, even if it's part of a diversified portfolio, don't be afraid to sell it and invest in something that has better potential. By diversifying your portfolio, you'll be able to sleep better at night, knowing that you're not putting all your eggs in one basket. And who knows, you may even end up making more money in the process. Mistake number 4 is paying too much in fees. Paying too much in fees is like getting nickeled and dimed when you're trying to save for your financial future. It's frustrating, and it can really eat into your profits. That's why it's important to be aware of the different types of fees that are associated with investing and to shop around for the best rates. One of the most common investing mistakes is not understanding the fees associated with a particular investment. For example, many investors don't realize that mutual funds typically charge an annual management fee, which can eat into your profits. That's why it's important to read the prospectus carefully before investing in a mutual fund. Another common mistake is not shopping around for the best rates. This is especially true when it comes to trading commissions. Some brokers charge high commissions, which can really add up over time. That's why it's important to compare rates from different brokers before opening an account. By understanding the fees associated with investing and shopping around for the best rates, you can keep more of your hard-earned money in your pocket. So don't let fees get in the way of your financial success. Be informed and take action to keep more of your money where it belongs. And finally, mistake number 5, which is not doing your research. One of the biggest mistakes that beginner investors make is not doing their research. Before investing in something, it's important to understand the risks involved as well as the potential returns. That's why it's always a good idea to do your homework before making any investment decisions. Many investors make the mistake of investing in something without fully understanding it. This is often referred to as investing in something because it's popular or trendy, but that's rarely a good idea. Before investing in anything, take the time to learn about it and understand the risks involved. What is the likelihood that it will go up in value? What is the potential downside? Is it a good fit for your overall portfolio? By taking the time to do your research, you'll be able to make a more informed decision about whether or not to invest in something. In addition to understanding the risks involved in any investment, it's also important to have realistic expectations. Don't expect to get rich quick. That's just not how investing works. The best way to avoid the mistake of not doing your research is to be patient. Take your time and learn as much as you can about the investment before making a decision. Don't feel pressured to invest in something just because it's popular or trendy. By being patient and doing your research, you'll be able to make a more informed decision and hopefully avoid making a costly mistake. All right, awesome. We've covered a lot of ground in this video, but let's quickly recap the 5 mistakes we've talked about. First, trying to time the market. Don't try to guess when the market will go up or down. Just buy and hold. Second, not having a plan. Develop a sound investment strategy that meets your needs. Third, not diversifying. Spread your investments across different asset classes and industries. Fourth, paying too much in fees. Shop around for the best rates and avoid high commissions. Fifth, not doing your research. Be patient and learn as much as you can about an investment before making a decision. We hope this video has been helpful and informative. If you enjoyed this video, please give us a thumbs up and subscribe to our channel for more great content. Remember, investing can be a great way to grow your wealth and secure your financial future, but it's important to avoid common mistakes along the way. Thank you for watching. We'll see you next time.